Shares of American Express are trending lower after the credit card giant reported profit that fell short of expectations. On the upside, revenue topped estimates, and AMEX raised its dividend by 16%. So for more, I'm joined now by Michael Miller, equity analyst at Morningstar. It's good to have you join us. Good afternoon.
Thank you. Thanks for having me.
So what do you think is causing the stock to trend in this direction after this earnings?
I think a big chunk of it really comes down to high expectations on the firm. American Express has been a really top performer within the credit card space for a while now. So I think the market just is expecting a lot from the company because, like you said, the actual baseline results were quite impressive, particularly its discount revenue growth.
The credit card company also increasing their dividend. What do you think is driving this confidence for the company to decide to actually do this? Because obviously you need confidence in yourself to be able to increase the dividend.
Yeah, it really boils down to, if you look within the U.S. luxury credit card space, American Express has kind of developed a really strong leadership position where they're seeing, new card acquisition well above just general population growth, which implies they are taking market share, right? So they've kind of developed this virtue. And on top of that, they've just very recently increased the fee on their platinum cards. So there's pretty reasonable expectation there that annual card fee income next year is going to be quite a bit higher than this year. So I think it really just comes down to they're kind of in this competitive driver's seat, and they've got reason to believe that revenue next year will be strong as well.
It's interesting when you look at where AMEX is most popular, and for the first time, Millennials and Gen Zers made up the biggest slice of U.S. consumers spending money on AMEX cards. Were you surprised by this? Like, where do you think that's coming from, and why is it just happening now that this is the first time?
So I actually think you're starting to see the impact of a pretty long process where the company really has transitioned its focus, where historically it's kind of been known for, older, really wealthy, kind of travel-focused card company, where really ever since honestly, the pandemic, there's been a shift more towards trying to increase Millennial and Gen Z signups. So you have actually seen in terms of new cards coming in that be disproportionately, Millennials and Gen Z. And I think you're finally starting to see the effect of that in terms of the spending breakdown for the company.
Do you think that the company is going to continue to cater to this demographic, or is there any risk to catering to this demographic, a demographic that, generally speaking, doesn't actually have as much money?
So I do think they'll maintain that focus, but really they're kind of targeting, affluent Gen Z millennials, right? So, for something like the platinum card, it's a $900 annual fee now, right? So you've actually seen them increase it. So there is this shift towards younger consumers, but they're still maintaining that kind of affluent focus within that demographic. In terms of risk, the really obvious one is we're seeing more lending occur on American Express cards. Does that lead to higher net charge-offs? And so far, the answer has been a pretty straightforward no. So it's something to keep an eye on. But so far, this strategy has gone extremely well for them. It's been a major part of the success over the last 3-4 years.
Obviously, U.S. President Donald Trump getting involved in credit this week, being quite outspoken. Same with the AMEX CEO, Stephen Squeri. He's criticizing Trump's proposed credit card cap. What kind of an effect do you think this will have, that outspoken nature of the CEO?
Yeah, so if you saw a 10% cap, AMEX would be affected. I will say, though, compared to other credit card issuers, they would be substantially less hit. And it really just comes down to American Express is still a spending-focused credit card company. They only get 25% of their revenue from net interest income. And then even within that 25%, because you kind of have this stronger credit quality, higher income focus, the credit card yields you'll see on Amex cards are just generally lower. So you're seeing a smaller decrease when you get capped at 10%. This isn't to say that they'd be immune. I would expect a hit to net interest income and total revenue and earnings. But compared to their peers, it's just not quite as impactful.
Okay. In terms of the rest of the fiscal year for Amex, what do you think that looks like? Are you positive on that note?
Yeah, so going forward, I think it was generally a really strong year for the company, especially the back half of the year. So Amex has had this issue where you saw kind of lower spending volume growth being offset by really strong net interest income and card fee growth. But as the year progressed, you saw that sort of balance out, where discount revenue has been increasing at a more rapid rate. You saw higher spending per card as the year progressed. So I think, honestly, it was a good year for American Express, and honestly, a little better than the kind of just top line, bottom line numbers would suggest.
In terms of the financial sector as a whole, do you like AMEX, or is there anything else you think investors should be looking at?
It's I would say these kind of consumer finance companies in general have been quite expensive. So I do kind of see American Express as overvalued. I lean a little more towards Capital One, primarily in valuation concerns, with the caveat that if you're just looking at competitive position and credit risk, American Express is a higher quality company. You're just paying a premium for it.
Okay, we'll leave it there. Michael Miller, equity analyst at Morningstar. Appreciate your time today. Thanks so much for joining us.